Darwin Platform Group of Companies is one of the fastest growing diversified Indian conglomerates with global footprints. It is setting up offices globally and tying up with companies across the globe from multiple sectors. The company has ventured into real estate and construction, stockbroking and finance, arms and ammunition, mining, airlines and many other sectors.
Hello and welcome to Business Today Television. I'm Siddharth Zarabi and you're watching Easynomics. The Reserve Bank of India under Shaktikanta Das has been increasingly becoming intolerant on non-compliance in the financial sector. I use the word intolerant very cautiously because what the central bank is actually doing is to crack the whip on various practices which it feels are not part of actual techniques, actual regulations and rules in terms of operating in this space. So why is the RBI cracking the whip? Why is the central bank, the banking regulator, showing the fist to all manner of non-compliance, and what will its impact be on the overall financial sector and particularly the fintech sector, where innovations and rapid use that has happened in India is being spoken about globally. Joining me on that debate is Sanjay Agarwal, Senior Director at Careedge Ratings. We are also joined by Abizer Diwanji, Head of Financial Services at EY, and Hemindra Hazari, one of the most noted analysts of the Indian banking space. Hemindra, I'm coming to you. RBI Governor को गुस्सा क्यों आ रहा है? If that is that, to paraphrase that famous line, what is really happening in the recent actions that you have seen?
Well, I sincerely hope that the RBI keeps cracking its whip even more vigorously on all these regulated entities. Because from what we have seen from the commentary put out by RBI, you will notice that in the case of Paytm Bank, Payments Bank, they said there was persistent non-compliance. That means the RBI had been warning them, they had found these violations, and even after having a long dialogue with them, they found that despite the bank and probably the other regulated entities assuring the RBI that they would have followed and corrected these practices, they had not done so. Therefore, in my view, the RBI has taken strict action, and it is necessary in the financial system that the regulator takes such strict action because the financial system is a strategic sector in the Indian economy. And if any of these companies and banks or regulated entities believe that in the name of financial innovation and financial reform, they can bypass various RBI or regulated norms, and that is permitted in the name of financial innovation, I am sorry, the regulator and even I as an analyst will not hold that view. And I believe that the RBI's action should be extremely strict because we cannot tolerate, the system cannot tolerate people violating the RBI or the regulator's actions at will. And it is extremely necessary. And I think the action should also be taken not only against the entity, but also all the directors, because they are also liable and accountable to the public as well as to the regulator. And so far, we've not seen that action, particularly on independent directors. So I believe that the RBI should continue to do this because obviously there are many players in the system who are taking the banking regulator and the financial sector regulator for a ride. And I hope that the RBI will continue to take such strict action.
Viewers, the last few weeks I have seen several steps and actions being taken. For example, on Paytm Payments Bank as a very famous example, IIFL Finance, JM Financial, and these actions have ranged from what is pretty much a death sentence as far as the Paytm Payments Bank is concerned, to other things like restrictions on the gold loan business. I want to come to you, Sanjay, and help our viewers put it in context. Do you think this is just the tip of the iceberg, and perhaps the banking regulator's gaze is going to be cast further wide and further afar in the field?
No, as you said, Siddharth, thank you for having me on the show. And as you said, Siddharth, there's been a varying degree of, let's say, the action by the regulator on various entities. In one case, they asked them to stop business totally. In other case, they said to restrict business in a particular line of business. And in the third case, it was a restrictive sort of a business for a subset of a business activity, right? So what the regulator is doing is they are sending out messages that we will not tolerate or we will not allow actions which are not in compliance with their requirements or probably the law of the land to take place. So to that extent, the RBI action is on the activity which is creating the discontent or the discomfort for them. In one case, I think they were issued in basic KYC itself, which is a very serious offense. In the next case, it was more of a business practice which is being questioned. And in the third case, it is a specific incidents which are being covered. So these are different incidents of a varying nature and have been treated differently. So to say that this is going to be a norm or it is a market-wide sort of a thing, I think we are overstating the whole concern.
Okay, that's a fair point. Abizer, is too much being made of it? And while there may be one very notable case, but by and large, the rest of the ecosystem is functioning pretty well. That, at least that is what it seems. Or does this point towards a larger systemic concern?
Well, clearly, I think the RBI's concern is that of a systemic nature. Two things which are changing. One is the changing business model of banking. I include NBFCs in banking. With more and more automation, more and more digitization, the whole business is changing, and there is a level of discomfort that the central bank would have in terms of those operations. The other thing is the desperation to grow and the creation of a bubble or a systemic risk. As you know, credit has kind of slid down the credit path. And we are now taking on more and more riskier assets, causing more and more systemic risk to the system. And if the central bank tries to, take control of the processes to make sure that the systemic risk is minimized or at least known, I think that's a fair point. My view is they have taken specific companies where the problems were acute and tried to exemplify them for the rest of the system. And I think that has to play out. The others who are not yet in the RBI's net need to make sure that they also control systems in a way and to control that systemic risk, which is primarily coming out of personal loans and loans where collaterals are kind of difficult to value, gold and shares, for example.
Okay, Hemindra, is there any parallel that we can draw with the so-called phone banking of many years ago and the regulatory response to that, and now to say and ask the question, is the RBI under Shaktikanta Das trying to ensure that there are no repeats of any past similar or dissimilar sorry episodes?
Is that question to me?
Yes, Hemindra Hazari, that question was to you.
In my view, definitely the RBI is cracking the whip more harshly, and I believe it is very much appropriate. Because you saw that even in the case of Bank of Baroda on its digital app, that they told them to stop onboarding customers there. I think this lesson has to go across the entire system, that if you're following tricky practices or you're intentionally trying to bypass and find loopholes in the law to promote your business, you are going to be punished. I think that is very important for all parties in the regulated entities to notice that no longer continue to your business model and think that you can get away with it. Because when you're doing something which is violating the law, you see, in many banks, companies, and this is a global phenomenon, they knowingly violate the law because the profits that they make from that is much more than the fine that they think will be imposed on them when they are caught. And that is actually, it promotes this kind of activity. So effectively, what the regulator has to do when they notice this is to see what is the gains that they have made from doing these violations. And therefore, the penalty that they impose should not only recoup all those ill-gotten gains, but on top of that, there should be a severe penalty. Now, unfortunately, in the past, what we have seen is that the RBI penalized them very nominally, and it was like a naming and shaming them. But they were all very proud to be shamed, it seems, because they did not stop such activity. Now, when the RBI is effectively either stopping the entire activity like they did in Paytm Bank, or stopping onboarding of very key businesses, as in the case of IIFL and JM Financial, it is going to hurt them, and we can see the hurt in their share prices. And nothing hurts more than for promoters and founders to see their share price take such a sharp correction, and that then disciplines them. And I'm glad that the RBI is doing such things.
Hemindra, I want to follow that up because what you are saying is also what the governor said at a recent event. He said one may own a Ferrari, but you have to observe traffic rules. So it doesn't mean that if no one's special as far as the market is concerned. A lot of the orders by Sebi get challenged at the Securities Appellate Tribunal, and then we go into a long sort of limbo there. As far as the RBI is concerned, and I'm glad you raised the point about fines as well, we see slaps on the wrist now and then. What is the difference between Sebi as a regulator and RBI as a regulator? Because in Sebi we see the SAT and orders getting delayed, and therefore justice in some ways perhaps taking longer to be delivered. Is there a similar situation or a comparison that you can draw as far as RBI is concerned?
Is that to me?
Yes, Hemindra, that question is to you.
See, I think it is in the structure, because SEBI came about much later than the RBI. The government and parliament decided their orders could be appealed to a higher authority. The RBI, since existence, was always the final authority, apart from the Supreme Court, or even certain cases the High Court. And sadly, what we've seen in SEBI is that most of their orders get overturned by the SAT, which shows that either there's something very wrong in the way SEBI is doing its business, or there's something wrong with SAT. So I think now, fortunately, unfortunately, we don't have this system with RBI, and therefore what RBI says is the final word, unless you are Kotak Mahindra Bank and takes RBI to the Bombay High Court, and where they got a very favorable response. But I think the structures of regulation are different. You have a higher authority for SEBI, which you do not have for Reserve Bank of India, and therefore you will find that Reserve Bank of orders or its penalties cannot or do not get challenged, while most of the SEBI's orders are getting challenged and overturned, which speaks really very poorly for the regulator.
Abizer, is this a watershed moment therefore for regulation in this regard, and that there will not be any going back to the past in some ways, and this is a new standard that the regulator is setting?
Oh, actually, the rules already exist. And if you look at what the regulator has done, is iteratively gone from giving them a notice first, imposing some fines, giving them time to correct, and thereafter reaching an extreme step in the case of, say, Paytm, to barring them from operations completely or shutting down the bank. So I think RBI, I don't think has taken any drastic step. It has just taken steps in an iterative manner, and depending on the gravity of the problem, dealt with it. So, for example, IIFL, they said, stop the business till you rectify something. Paytm, they said, sorry, stop the bank. Because they had given them enough time. So, I think what we really need to understand here is that there are people who have impacted the systemic risk and have challenged that. And those people, despite warnings, have not done much. Though Hemindra says that, Sebi has kind of has a sat above it and hence it's renders itself ineffective. I do believe that every regulator needs to have a responsibility and a challenge. So RBI in this case, I would have loved it if everything was explained to say this is the reason why I am barring somebody or reducing an activity of somebody. These are the following reasons why I have done this. Because then what happens? Then you're truly exemplifying a situation. Because this is not about an IIFL or a Paytm in particular. It is about them, of course, because they've done the wrong. But it is clearly about passing on the message to the rest of it that this is what you need to do right. Because the problem doesn't lie with the JM. If you look at the JM's loan against share portfolio is 1.5% of the total book. But that's not the issue. The issue is there are many other people who may be funding IPOs. And because of which IPOs may be showing, incorrect oversubscriptions. Those have to be corrected. So I think the problem is much larger in terms of the excesses that we deal with the system. The larger issue that we have is that we are, as consumers are yield chasing on the liability side. So we tend to increase our SIPs and we tend to overheat our stock markets and tend to oversubscribe our IPOs. At the other hand, the banks are suffering liquidity issues on terms of deposits. On the asset side, we are now doing aspirational spending through personal loans. And that is also causing another problem. And fintechs are originating that and supplying that. So if you look at it, the problem is that we are now overstepping. India is overstepping for the first time in terms of its consumption, in terms of its assets. And it is yield seeking in terms of its liabilities. And that is the business change model that one has to deal with. And RBI is rightly worried about that.
Sanjay, is there a reason for the RBI to be so worried? This is a relative comment because we don't know the full scale and extent of the problem, and Abizer made that very important point, which I completely agree, that sometimes the clarity or lucidity of certain orders at least leave average people like me completely ignorant of what really has happened, because central banks speak is very mysterious most of the time. But Sanjay, what's your comment on that point?
So if we go back last 5 years, we've seen 2 years of COVID and then 2 years of business operations resuming normalcy, etc. So they have been time with ups and downs, right? In COVID, people were more busy about protecting the turf and the asset quality and businesses, etc., compared to the growth. And now we see 2 years of growth, and the growth has been pretty explosive, especially on the personal loan. And if you see the action RBI has been doing is largely on gold loans, etc., or personal loan, which is where the end use is not monitored or end use is not given. So there is a sort of a pattern to the whole action that where end use is not given, probably some of the excesses may have started happening, or that is where people are probably trying to grow their businesses in much aggressive manner than what probably end use monitoring system would have given. Having said that, this sort of action RBI has been taking means over the period. Now it's come to the notice because there's been slightly more stringent. But that is how it is. It's basically trying to tell businesses that we need you to work in a particular manner. The other thing which is missed, especially in terms of NBFCs, is that the NBFC supervision has been tightening over, let's say, 4 to 5 years now, or probably 6 years. So with that, probably the supervision levels have reached a particular level of maturity, which gives the regulator confidence enough to take certain actions, which will correct the whole ecosystem and especially the company concerned out there. So that it's a evolution, it's a path. The path will take its own natural course of action, and that is how things are moving ahead.
Do you think, Sanjay, a quick follow-up, that any of these actions could prevent innovation? And while I ask you that, I must also tell you that as far as payment bank are concerned, in the past, certain companies have said thank you and bye-bye to that business, saying that the compliance and the requirements are so onerous that it doesn't make sense to be in that business.
So innovation outside the or bypassing the regulation is, I don't think, something that the regulator or the government or the public at large would want, because there is a regulatory sandbox structure. Then there is a structure where you discuss with the RBI and other regulators. All of them promote innovation. All of them discussing. There are specific teams to do all that. So innovation does not mean bypassing rules and trying to be more smart about the whole thing.
Absolutely. The same example of the Ferrari, and if I could add, even driverless cars will have to follow the rules, whatever that may be, that are set by the system. Hemindra, broader point here, and Abizer touched upon that. Couldn't it also be argued that rising gold loans are also a signal of economic stress, where people are parrying assets to continue with day-to-day spending or occasional important spending as well?
Very correct. I'm glad you have raised this issue, because what has gone largely unnoticed is that corporate loans has not been growing, which tells you why banks, where the deposits have been flowing into the financial system, have to be deployed somewhere. And when the corporate sector is not growing, when your manufacturing GDP has remained stagnant for so many years, where employment in manufacturing has been totally stagnant while your population has been growing, it tells you the kind of stress in the entire economy. When FMCG sales by volume are not growing, which are items of mass consumption, it tells you the purchasing power of the average Indian. So it tells you very much, as you very rightly pointed out, that when there is distress, people will pledge whatever securities they have to you just to meet their consumption. It is not that they're going to take that loan even for some productive asset. So it does tell you, and therefore there are wider economic concerns here, which sadly the media does not like to highlight too much. And we all say, yes, oh, retail loans are booming, but they're booming really because the banks have really nowhere else to fund where the deposits keep growing. So there is a wider problem which needs to be addressed by the government as well as by the central bank as well. Because and you cannot keep growing, the retail loans when the economy is under stress. But in today's environment, most people or many people believe that the economy is booming. So we have to first diagnose the problem. And when you're not willing to diagnose the problem, you really do not know what the cure is going to be.
Okay, Hemindra, one quick follow-up, and this is to do with one particular case, and this is Paytm. Do you think there is any possibility, even a slim one, of any light at the end of the tunnel? There is an extension, but are the doors fully and finally shut, or can there be a review somewhere down the line?
See, very clearly, post RBI action, the board of the bank and even the entire structure has been totally revamped. The promoters have stepped down. Both the chairman has stepped down as well as the other executive directors. I mean, the directors who are appointed by one Paytm Communication. Now, in any leveraged entity where there is a promoter, there is a tendency for the promoter to constantly interfere in operations, and more importantly, of maintaining control. Therefore, I've always believed that in banks, ownership and management must be distinct and separate. And when they are merged, you have this problem, which I think is very much so in the case of Paytm Bank. But now with the restructured board and with the withdrawal of the chairman, I think there could be a chance that the RBI may look at it and may reconsider. But based on its original ruling at that point, it looked like there was no hope for Paytm. But I think there is, and there could be a glimmer of hope after they've restructured the entire board.
Sanjay, the same question to you. Do you think there is any possibility that with changes there could be a rethink?
No, so as a policy, we do not, let's say, comment on specific names, etc. But as a regulator, whenever we have discussed with either Sebi or RBI, they have different turfs actually. So RBI has to look after the institutions while Sebi has to look after the investors. So these are different turfs altogether. Having said that, when you look at the institutions, they are supportive. They want to guide the businesses, organizations to do business in a particular manner, especially since now we are getting into a more and more uncharted territory of significant amount of digitalization, straight through processing, where in many cases there's nobody involved except for a single, let's say, unit anywhere. So these are different times, and the regulations obviously will be different. But having said that, we have seen that the regulators are keen to support businesses, enable them to grow and foster. And we feel that they will take all the steps which are necessary to that. I mean, especially in the case of, let's say, fintech, there is a specific teams in both the regulators to take care of fintechs, understand the issues, go ahead with them, educate them, put in the regulatory sandbox, discuss how we can take forward, how we can expand the whole offering to the entire sector. A lot of those actions are there. I mean, we have come all the way right now because of whatever regulators have done. That's a very large piece of the whole gamut.
Absolutely. A final word from you, Abizer, on that same question regarding the future of Paytm Payments Bank.
Yeah, I think the payments bank will find it difficult to survive. The Paytm as an app and a payment aggregator is, I think, where the opportunity will be. So I'm not sure whether RBI will trace back just because the management has changed. If the ownership changes, then there could be a different issue. Somebody could buy it.
Absolutely, and the reason I was pursuing that question was not to sort of get to know about that particular company alone, but the broader point that with the RBI cracking the whip, viewers, on a space that has delivered innovation, that has delivered ease of use, ease of access to banking services, at least in urban India, and has come very handy at times of COVID and after that. There is clearly a fine balance that needs to be struck. And as far as the regulator is concerned, there can be no questions that India's financial system overall and specific verticals within that need orderly and supervised growth. And in that, what the RBI is doing and may continue to do in the future is absolutely required. And we will continue to analyze and decode such actions with the kind of eminent experts that we had on today's show in the future as well. Hemindra, Abizer and Sanjay, thank you very much for your time with us today. With that, it's a wrap on this episode of Easynomics. We'll be back with more. Until then, goodbye.